This additional video is a video about the gift transparency principles that we've spoken about at several points during this series. And what we're going to do in this video is look at how they might be applied in a little more detail. The gift transparency principles represent an escalating scale of ambition. Broadly as explained in previous videos, this covers basic, intermediate, advanced, and aspirational levels. Consequently, the principles can be applied to document actual practice in any jurisdiction, working through them sequentially to get a reading on how transparent processes for formulating tax policy, administering taxation, and communicating about it actually are. Such an exercise can also be used to identify areas of poor performance that might be improved upon. The principles are a device and a guide for improving tax transparency performance over time on a step-by-step basis. When performance on the basic principles can be shown to be strong, a government and a civil society can move on to improving the extent to which they fulfill intermediate principles, then advanced principles, and ultimately begin to engage with aspirational elements such as tax gap analysis and tax spillover assessments. The principles are written at a sufficient level of generality to enable them to be applied to a country's specific economic, legal, administrative, and cultural arrangements. They do not aim at detailed prescriptions for national legislation, but provide a robust and flexible reference point for policymakers, civil society groups, and commercial interests to have their own dialogue on the frameworks for taxation and the levels and types of transparency they should be aspiring to. Indeed, the principle's main purpose is to promote and produce such a dialogue. So now let's take a deeper look at how that might work in practice in relation to the individual principles. The caption on the screen you should see now is the first principle. This principle 1 is a broad one. It establishes that it's desirable for governments to be open about their intentions on taxation and should try to make as much information about those as possible. Broadly, this means being able to demonstrate intent to make information available rather than concealing it as a basic foundational principle. The principle involves assessing the extent to which a government is willing to make information available, to consult widely, that due process for this exists and is widely used. This principle is really a question of assessing whether there is a general culture of and commitment to making accessible information about the tax system in different forms, and what evidence there is of that in terms of procedure and quality and depth of information. The actual notes accompanying this principle identify 9 questions that might be posed and worked through to help assess the overall culture and broad commitment to transparency in a given jurisdiction. Indeed, each of the principles has accompanying guidance notes of this kind on the sort of questions that might be asked to inform a judgment on the degree to which a principle is represented in and respected by governance practices in the jurisdiction under consideration. Actually reporting on the extent to which the principles are respected or followed in a jurisdiction can therefore be attempted based on a thorough reading of the principles document. On the screen now you should see the second principle. Principle 2 is less general than Principle 1. It focuses on assessing the extent to which governments state clear, measurable objectives for the tax system on an annual basis. The principles are informed by a view that tax is not just about revenue raising, but can powerfully shape economies and societies. Tax transparency is aided when governments recognise this and try to be as explicit and clear about their intentions, aspirations, and rationales as possible. This is basically the question of whether a government clearly communicates the purpose and intention behind its tax policy and its hopes for the tax system, and whether it reports and reflects on whether it's meeting its own stated objectives. 7 further areas are specified in relation to Principle 2, including fiscal and socio-economic goals, views on fiscal management, income and wealth distribution, market failures, what is taxed and why, the assumptions and beliefs underpinning the setting of tax rates and reliefs and exemptions, and the beliefs informing the funding and procedures for tax administration. In short, Principle 2 guides governments on how to reflect on their tax policies and procedures, and the informations and rationale they should be making publicly available, all with a view to informing, enhancing and stimulating a culture of public knowledge and information and informed debates on taxation. Further basic principles include how information on government accounts should be broken down, reported and explained, legal codification of taxes, and their administration, including meaningful consultation on changes to that codification, access of taxpayers to advice and information on their liabilities, and meaningful redress mechanisms and the terms of taxpayer confidentiality. Once we get to intermediate level principles, this involves governments providing more detailed qualitative explanations of the choices they make and the wider social and economic contexts revealed by tax data. Commentary on budgets and accounts, including explanations of deviations from prior projections, accountability mechanisms that tax administrators should be subject to, and international reporting obligations. At the advanced level, the principles call for establishing a method for reporting on legally owed tax that goes unpaid, for examining and evaluating the impact of reliefs and allowances in terms of their costs and benefits to society as a whole on a regular basis, and a process for auditing and evaluating the timeliness and reliability of tax data. In short, it is possible for any jurisdiction to work through each principle and reach a judgment on the extent to which it is embodied in the tax practices of that jurisdiction, documenting that in relation to each principle. Such an exercise could also identify areas where improvements could be made, really by doing little else than following and applying the guidance notes, accompanying each principle to an evaluation of practice on the ground. Applying the principles in this way could therefore generate a targeted reform agenda to improve tax governance and its transparency, especially if a compliance or evaluation report on the extent to which a given jurisdiction meets the principles was published and made publicly available. We, both Richard and I, and the staff at GIFT would encourage all governments to consider such an evaluation, and for civil society actors to call on governments to take such steps, or even to conduct and make public their own transparency evaluation using the principles as the evaluation framework. The ultimate goal of moving towards enhancing tax transparency and the gold standard of tax transparency comes in Principle 14. You should now be able to see on the screen Principle 14. A tax gap analysis calculates the gap between revenue that could potentially be collected and what is actually collected in a jurisdiction in a given time period. The task following on from that is to explain and analyse the potential sources of that gap through a tax spillover assessment that identifies the weaknesses, risks and contradictions that exist within a tax system and the types of tax risk that result from this. This offers it a targeted reading and can identify steps to address weakness and reduce the risks a tax system generates while providing a means for reducing the tax gap and improving revenue collection. A tax spillover assessment can help with the following: raising additional tax revenues without increasing rates or extending the tax base, identifying weaknesses in the functioning of tax law or how and where tax rule enforcement could be made more effective, identifying targeted measures to improve overall fiscal management of the economy, establishing whether incentives and other arrangements to encourage particular behaviours built into the tax system are delivering on their original intended objectives, or whether they are having distorted unintended consequences, such as producing exploitable legal loopholes or creating incentives that undermine other parts of the tax base. Determining the extent of tax compliance, including whether groups and individuals are paying their appropriate and correct share of taxes owing, or whether the burden falls inappropriately on the law-abiding or those without means to exploit legal loopholes. Assessing how the Tax Revenue Authority is performing, whether it is adequately resourced and whether funds are being used to best effect, and evaluating international tax relations and vulnerabilities, especially to specific forms of tax competition pursued by other countries. Various methodologies for conducting tax spillover assessments are starting to emerge. We as authors designed a qualitative assessment framework to complement the quantitative estimates coming out of a tax gap analysis and/or econometric analysis. You should be able to see a graphic of the piece that we wrote for the journal Global Policy on the slide. Our framework involves trained experts using questionnaires, surveys, and interviews to build up a picture and set of impressions about how widespread certain practices and behaviours in a tax system are. Collecting field notes and descriptions of this would inform the allocation of risk scores on a 3-grid system of 64 outcomes or risks to effectively evaluate and score 192 separate spillover risks in total and give a full systematic reading of every aspect of a tax system. The accompanying qualitative notes and explanations for each score allocated could be used to provide extensive commentary on each risk matrix, and on that basis make remedial suggestions to address the biggest risks a particular tax system and jurisdiction was generating. A tax spillover assessment would therefore generate a comprehensive spillover report on the risks present in a particular tax system. We have published a toolkit setting out the areas to be covered and the questions to be posed in conducting a spillover assessment. This is a loose guide and can be adjusted and refined to suit a country's specific and particular set of circumstances. This toolkit and methodology is available on request from Richard and I, though it can be downloaded from the Wiley website hosting the journal Global Policy, and the open access online version of our paper at the following link, which you should be able to see on the screen. The document toolkit can be downloaded at the section at the end of the article entitled Supporting Information. So to sum up and in closing, countries can use the principles to put in place the conditions, procedures and data that would enable a tax spillover assessment to be conducted. Multiple actors, including governments, tax authorities and civil society groups, would obtain benefit from such an exercise in some of the ways already suggested.